Hey everyone, welcome back to Corporate Decoder, the place where we shine a spotlight on the nitty-gritty of corporate America. And sometimes, folks, the shiny bits are hiding behind some really interesting numbers. We are diving into First America Resources Corporation S latest 10Q filing. Now, this is a quarterly report, so it gives us a snapshot of how the company is doing in the most recent period. And what we were going to see here is a significant shift that happened in April of 2025 that really changes the picture. Before we jump into the details, if you appreciate getting straight insights from these corporate documents, please make sure you are subscribed and ring that notification bell. We also have a community Discord server linked in the description below where we unpack these findings in even more detail, so definitely check that out. Today, S filing is all about the Q2 results for 2025, and the big story seems to be the impact of a recent acquisition. Alright, let S get into it. So the headline here is that on the 16th of April 2025, First America Resources Corporation, which we call FSTJ for short, completed a deal where they acquired 100% of a company called METech Recycling Incorporated. This is a pretty big deal because it looks like METech is now the main engine of FSTJ. In financial terms, this is treated as a reverse acquisition, meaning METech is considered the buyer, even though FSTJ is the legal entity that filed this report. This is because METech was the larger or more dominant company in the deal. So what this means is that the financial statements we are looking at here from April 2025 onwards are really showing the combined results, but the historical numbers and the assets and liabilities are largely from METech. They specialize in electronic waste management and in asset disposition, which sounds like a pretty critical service in today's world. They are R2 certified, which is a big deal in the recycling industry, meaning they follow strict environmental and data security standards. Now let's look at the balance sheet, the snapshot of what the company owns and owes at a specific point in time. As of the 30th of June 2025, FSTJ had total assets of about $6.9 million. That is pretty close to the $6.8 million it had at the end of 2024. But here's where things get interesting. The cash on hand has dropped significantly from around $459,000 at the end of 2024 to just about $151,000 at the end of June 2025. This big drop in cash is something we need to keep an eye on. On the flip side, their liabilities have also shifted. Accounts payable to related parties like First America Metal Corp, which was over $2.3 million at the end of 2024, dropped to about $1.5 million by mid-2025. Also, their total liabilities decreased from about $8.2 million to $8 million. This is good, but it is important to remember these are numbers after the acquisition. Now let's talk about the ownership structure. The company S common stock has a par value of just a fraction of a cent, $0.001. They authorized a massive 500 million shares, and as of both the 30th of June 2025 and the 31st of December 2024, they had 879,64090 shares issued and outstanding. This huge number of authorized shares often hints at future fundraising or stock-based compensation plans. Their total stockholders deficit, which means their liabilities exceed their assets, is around $1.1 million at the 30th of June 2025. This is an improvement from a deficit of about $1.4 million at the end of 2024, which is a positive sign. Diving into the income statement for the 3 months ending the 30th of June 2025, revenue was about $4.8 million. That is a pretty solid jump of 30% compared to the same period in 2024, when revenue was about $3.7 million. This indicates that the acquisition of METech is already boosting the company's top line. For the first 6 months of 2025, revenues reached approximately $8.8 million, an increase of about 13% compared to the $7.8 million in the first half of 2024. So revenue growth is definitely a theme here. The flip side of revenue is cost of revenues. For the 3 months ending the 30th of June 2025, these costs were about $2.3 million. This resulted in a gross profit margin of 51%, whereas in 2024 it was 57%. So while revenues are up, the cost of generating those revenues has also increased a bit more proportionally, leading to a slightly lower gross margin. A 6 percentage point drop in gross margin is something to watch. For the 6-month period, the gross margins were flat at 54% for both 2025 and 2024. The main costs here are freight and material processing, so it looks like those costs are moving with revenue. Now let us look at operating expenses. For the 3 months ended the 30th of June 2025, these were about $2.38 million, which is an increase of about 16% from the $2.06 million in the same period of 2024. This rise seems to be driven by increases in general and administrative expenses, which went up by about $83,000 payroll expenses, by approximately $118,000, and rent and lease expenses by around $92,000. They attribute these increases to expanding operations, which makes sense with the METech acquisition. Professional fees also saw an uptick from $54,000 to $86,000, likely due to merger-related costs like legal and audit fees. For the 6-month period, operating expenses increased by about 13% from $4.06 million to $4.75 million. General and administrative expenses alone jumped by a significant $303,000. Again, this is largely tied to the expansion. So how did this all impact their operating income? For the first 3 months of 2025, FSTJ reported an operating income of about $95,000 compared to just $43,000 in 2024, showing improvement. However, when we look at the 6-month period, FSTJ actually reported a small operating loss of $432 for the first half of 2025, whereas they had an operating income of about $172,000 in the first half of 2024. This is a bit concerning, a shift from profit to a slight loss over 6 months, even with increased revenue. Other income and expenses show interest expense climbing from about $24,000 in Q2 2024 to $36,000 in Q2 2025. They expect this to rise further as they take on more debt. On a brighter note, they received an employee retention credit totaling about $346,000 during the first half of 2025. This credit significantly boosted their net income for the 6-month period to around $287,000 compared to $130,000 in 2024. Without that credit, the picture would be much less rosy. Looking at cash flow is crucial for understanding a company's ability to operate and grow. For the first 6 months of 2025, FSTJ used about $250,000 in cash from operations. That is a big change from the $18,000 cash provided by operations in the same period of 2024. This means the combined entity is currently burning cash faster than it is generating it from its core business. This is despite the net income boost from that employee retention credit. Investing activities were flat at $0 for 2025 compared to about $74,000 used in 2024, which suggests less investment back into the business for now. Maybe due to cash constraints, financing activities used about $58,000 in 2025 compared to just $9,000 in 2024. Overall, their cash balance significantly decreased by about $308,000 in the first half of 2025, bringing their ending cash to roughly $151,000, down from $459,000 at the start of the year. This is a clear indicator that liquidity is becoming a concern. Let's dig a little deeper into this METech deal. The common stock exchange agreement happened on the 16th of April 2025, and it means FSTJ acquired 100% of METech. FSTJ issued 80 million shares of its common stock to METech shareholders. The accounting here is tricky. It has been presented retrospectively, which means they've gone back and restated historical financials to reflect METech as the acquirer. They consider this a reverse acquisition, meaning METech as historical financial data is essentially being brought forward into FSTJ. You can see in the statement of stockholders deficit that the equity of the company is largely the historical equity of METech after the reverse merger impact. Now let's talk about customer and supplier concentration. For revenues in the first half of 2025, customer A accounted for 15% and customer C for 10%. In 2024, customer A was 22% and customer C was 16%. So there has been a slight diversification away from these two largest customers in terms of revenue. However, for accounts receivable, customer C made up 21% of receivables in 2025 and 22% in 2024, and customer D represented 16% in 2025 and 14% in 2024. These concentrations mean that the company is still quite reliant on a few key customers, which can be a risk if one of them has financial trouble or decides to take their business elsewhere. On the accounts payable side, vendor made up a substantial 43% of payables in the first half of 2025 and a whopping 69% in 2024. This indicates a heavy reliance on a single major supplier. This is where things get really interesting. The company has significant transactions with related parties. At the 30th of June 2025, they owed $556,000 to First America Management Group Corp, a major shareholder. They also owed $657,000 to First America Metal Corp, or fancy another major shareholder. FAMC is also identified as customer A and vendor A, so the company is selling to and buying from a major shareholder, which can be a complex situation. They also owed $151,900 to FAMC for accounts payable. This close relationship with major shareholders and significant related party transactions are certainly points to scrutinize further. Now, in their management discussion, they highlight revenue growth, but also note the slight decrease in gross margins for the 3-month period. They acknowledge that operating expenses are increasing due to expansion and are expected to continue to rise. The shift from an operating income to a near zero operating income for the 6-month period is also noted implicitly by the numbers. They also mention the ERC credit positively. Under liquidity, they admit that cash has dropped to $151,000, and importantly that cash used in operations was $250,000 for the first 6 months of 2025. They expect cash used in operating activities to be neutral as they expand, which seems a bit optimistic given the current burn. They also state they may need to raise additional debt or equity capital to fund operations, and that there is no guarantee they'll be able to do so or on acceptable terms. This is a clear red flag about their ability to continue operating without new funding. The executives have concluded that the company's disclosure controls and procedures were effective as of the 30th of June 2025. This generally means they believe information required to be disclosed is being properly recorded, processed, and reported on time. However, they also include a standard disclaimer about the inherent limitations of any internal control system, noting that it can only provide reasonable, not absolute assurance. Here is a bit more detail on that big acquisition. In the unregistered sale of equity securities section, they clarify how those 80 million shares were distributed. First America Metal Corp received 29,056,00 shares, and First America Management Group Corp received 50,944,000 shares. Both of these entities are owned by Mr. Jain Lee, the company, Director, Chief Executive, and Financial Officer. This means the entire issuance of shares to effect the acquisition went to entities controlled by the CEO, which is a significant related party transaction to consider. And finally, the report is signed off by Jain Lee as Principal Executive Officer and Principal Financial Officer on the 29th of September 2025. So what is the story here? First America Resources Corporation, FSTJ, has clearly undergone a pivotal change with the acquisition of METech Recycling. The revenue numbers are showing growth, which is positive. However, there are several red flags that cannot be ignored. The shrinking cash balance, the shift from operating income to a near break. Even on a 6-month basis, despite revenue growth, and the significant increase in cash used by operations are all concerning. The company acknowledges it may need more capital and that this is not guaranteed. The heavy reliance on a few customers and a major supplier is a risk, and the significant related party transactions, especially the share issuance going entirely to entities controlled by the CEO, warrant careful consideration. The positive impact of the employee retention credit masked some of the underlying operational cash flow challenges in the net income figures. In my opinion, the direction is set by the METech acquisition, which brings in revenue but also operational costs and cash burn. The biggest immediate strength is the revenue growth, indicating market demand for METech services. The biggest weakness is liquidity and the cash burn rate. A key risk is the dependence on external financing, which is not guaranteed. An opportunity clearly lies in scaling METech operations efficiently. Overall, FSTJ is in a transition period. The acquisition offers potential, but the immediate financial health, particularly cash flow and liquidity, needs very close monitoring. The company is operating at the edge of its current resources. Alright, that is our breakdown of First America Resources Corporation, latest filing. What is your take on these numbers and what they signal for the company? Future, drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.